Insurance is a critical risk management tool for businesses, but what happens when disaster strikes and your coverage falls short? How can businesses structure smarter, more tailored insurance solutions that truly protect their assets and ensure continuity? Welcome to the Policybazaar for Business show partnered by ET Now. I'm Kavita Thapliyal, and today we are exploring the evolving landscape of comprehensive risk management and how effective insurance strategies can safeguard your company's balance sheet against an increasingly complex array of threats. Joining me in this conversation, I have Ankit Maheshwari, Deputy CFO, GR Infra Projects, Amitabh Dewan, Associate Director and Business Unit Head, Policybazaar for Business. All right, so let's begin. And Ankit and Amitabh, welcome to the show. And we are going to be talking about balance sheet protection. So first, let me begin with you. What are we talking about balance sheet protection over here? If I have to understand this in terms of coverage options offered to corporates, what exactly is offered?
So what we intend to discuss here and what we intend to do on the balance sheet protection is because, see, for any of the corporates, there are a lot of risks. Some are tangible, some are intangible. Even the intangible risks do sit on the balance sheet, whether those could be some of the assumed liabilities or some third-party claims or bodily injuries that can come in, which is something where there is no as such a tangible asset where it is shown in the balance sheet. So what we are trying to do here is, in insurance, we are covering one, the tangible items, which are like the assets, properties, marines, even the employees, because employees are one of the most important people who run the organization. So whether that is something on the employee benefits or we are talking about marine, the exposure that we have in transit, the fixed assets, the plants, also the interruption losses, because tomorrow if there is any claim, if there is a loss of profit, then loss of profit also gets covered. And any of the liabilities assumed while conducting that business is a protection which is provided by number of insurance policies that are there.
Okay.
And that's where we come in and support our clients in terms of protecting their balance sheet. Tomorrow, if there is any claim happens, then how do you make sure that your company is stable enough and the balance sheet remains strong enough?
How in tune are you with this kind of an offering and what you do to protect your balance sheet in the same manner?
Yeah, first of all, thank you for having me here. From my side, it's a three-dimension strategy, I would say. So the first one is self-insured retention. The second one is the contractual. And the third one is, of course, the insurance. So I'll just brief you about these three elements. So when I say self-insured retention, so the company should have a robust framework, and having the mitigating strategies to reduce the risk so that the risk appetite of the company increases. And when the risk appetite of the company increases, there is some portion of risk which company can absorb.
Okay.
By contractual, what I mean, you draft your agreements with your contractors, subcontractors or suppliers in a mutually respectable manner so that some portion of risk can be passed on to your contractors or suppliers.
Okay.
And third one is, of course, the insurance. So there are multiple type of insurances available in the market, like property insurance, general liability insurance, D&O, etc. And through these products, the risk can be passed on to the insurance companies.
Okay. So are we talking about all kind of offerings that he mentioned?
Yeah, absolutely.
As policies?
As policies, because the market and the insurance industry as such, within the different lines of exposures, they have different policies. So it's not like there is a one policy covering your complete balance sheet or the complete exposures.
So we are talking about risk-based and sector-based policies. So what do you have then?
Since I come from the infrastructure background, and for us to cover the project risks when we execute the projects, when we construct the asset for the country, the protection of risk at that stage is very important. And secondly, once the asset is being constructed, it is also required to be maintained for a long term or a long period of time. And then for that maintenance, the fire policy or operational policy, what we may call, becomes important.
How do you evaluate that?
So what happens is, like in an infrastructure company, when you're building an asset, you have a lot of exposures because at a particular location where you're building up an asset, there'll be some goods that you will be transporting it to that particular site.
Okay.
That erection needs to be done on that particular site, so or a construction needs to be done there. So that construction, there is a policy called erection all risk or a construction all risk, which we typically name it as a project insurance.
Okay.
So till the time the asset is being constructed, everything gets covered under the project insurance. It then moves to the operational. So like Ankit rightly said that you have to maintain the asset for multiple years. There is a bridge that they have made, there is a tunnel that's made. Now that needs protection from some of the catastrophic perils, something like fire, something like a landslide. So all of those gets covered under the asset insurance, which we normally talk about as a operational property insurance.
Okay.
While the use of that asset, there can be some third-party liabilities that can come in. For example, there is a bridge. We saw very recently that there was few bridges which fell down. People lost their lives. There is a third-party liability claim that comes in because somebody who was using that asset suffers a bodily injury or a property damage. And hence, there are certain liability policies which cover it. While that's more on the third party side, but also for a company who and the directors who had taken a decision on how the construction has to be made, their civil engineers, their multiple things, those people also get exposed to any kind of those liabilities. So there is a D&O insurance, there is a professional indemnity, there are certain cyber risks. So it's a whole lot of things where we do a stress testing of what kind of exposures this particular asset can get in, and then where are the vulnerabilities.
Okay.
Some of the things are transferred to their contractors, to the subcontractors who have built it by way of contract, by way of the assignment of the contract, and the rest are all retained by the corporates themselves.
Okay. But you also get into the fact of, like, for example, what kind of contractor hiring is going on, what kind of materials. Do you also get into all of those nitty-gritties before giving them a proper structure or a defined policy?
Yes, I think.
Yes, I can add to it.
Yeah.
So generally, all the companies who have a good corporate governance mechanism, they follow a process of due diligence. So we also do that.
Okay.
So before hiring or recruiting any vendor or subcontractor, there is a stringent due diligence process which goes into it before we onboard any contractor or supplier.
Now, talking about deciding the sublimits and other aspects in the policy, how is the capping decided?
So it actually depends on the kind of asset or the kind of program that we are structuring. The first one is certainly that how strong is a company who's buying that insurance program.
Like you can give the example and explain maybe.
So an example could be a company has a good cash inflow, they have lesser debts, they have lesser loans, and their balance sheets and their finances, their incomes are strong enough to accept certain kind of losses or up to a certain limits. Those kind of limits can be taken as a deductible under the policies wherever it is feasible, and the balance gets insured. So how we do is, basically there are three things that we try and work on. The first is the identification that where all the exposure exists. Then there could be something like during the construction phase, there can be a fallout. During our operational phase, there can be any kind of claim. So there can be a marine or a third party liability, or could be anything. So after we have actually identified into the whole project as to what can go wrong, then we do some kind of a simulation that if in case this was to go wrong, what is a kind of damage? Some things are very easy because it's more of a material damage. You know the cost of the materials and that can be paid. The second one is that somewhere where there is a assumed liability or maybe something which can come from a third party. So that all goes into the identification and in terms of the quantification of that risk. The third one is where we get into foray and where we also seek support is where we get onto the risk reduction. How do we reduce all of those exposures that we have probably identified? Those reductions could be by way of not getting into those things, if it is possible. maybe pushing it on to the subcontractors or to the other people who are working on a particular project. The third one could be where we identify that there is no way that we can escape from this kind of a liability. And then we look at the insurance policies and design the covers for them.
But that's again sector specific, right?
Yes, that's sector specific, and that's very specific on the kind of asset we are insuring.
Talking about the coverage that you have, how much of it has been customized from your end?
So largely, I would say that the industry is having fantastic products which we can use and file. But as we were discussing, yes, every project is unique because every terrain, territory, geography is unique. So it has to be customized accordingly. When we talk about limits, what I think or what I suggest that one, there could be a flexi limit, which means that other than whatever standard product is available in the market, after a thorough risk assessment of the particular asset needs to be insured, those limits should be flexible as per the business requirements.
Okay. Which is not currently?
Which is there, but we need to, understand the insurer that why we are suggesting certain limits. So if we have right mitigating actions in plan, right working methodologies, etc., then those limits can be customized also.
Okay.
Second is the aggregation of limits, which means that rather than looking one particular policy and capping the limit, there can be a possibility whereby the limits can be aggregated for the multiple projects or multiple insurance policies. And the third one is the pre-occurrence limits. So it is for a specific risk or for a specific claim that one limit can be decided. So there are various, methodologies which are available based on which it can be worked out. Second is from the coverage perspective. So again, coverage can also be customized.
Right.
Basis your requirements and whatever elements of risk you want to protect through that particular policy. The second could be the excess coverage, which means that though the standard is also available, but if someone is suggesting me or the insurer or the broker, can go for the excess coverage by, paying some additional premium, etc. So that can also be linked into this. And third one is, let's say, umbrella coverage.
Okay.
So which means the coverage for all risk type of policies or where you can cover the multiple risk under one particular umbrella and cap that limit accordingly.
Okay.
And then comes the deductibles, because let's say you have taken a policy of 100, right? And insurance companies say that if the claim comes, minimum 5 will be the deductible, for example. So again, on the deductible thing, there can be strategies which can be drawn and which the companies are doing. So again, it has to be flexible as per the business requirements. Second is the excess deductible credits, I would say. So what I mean by deductible credits, let's say if a company has a healthy claim ratio or no claim ratio.
Okay.
So that kind of credits can be accrued. And when you go for the renewal, those credits can be used, to further reduce the deductibles. And third is the deductible waiver. So for certain type of risks, certain deductibles can be waived off either initially or later on. And the last one would be the retention, which I talked initially also, that self-insured retention, which means the company can take on their balance sheet depending upon their risk appetite. And second could be the large deductibles. So there are certain high-risk projects where the standard deductibles probably may not work in the market. So there we need to mutually agree that what could be the right amount of those large deductibles.
How much of this is actually implemented and how much is work in progress?
So a lot of it is already implemented. A lot of it, the policies in many cases are tariffed, they're regulated, so there are very few modifications that can be done. But looking at the kind of the structure of the policies, we see that a lot of risk automatically get covered. Especially if we talk about certain projects or something, then there are a lot of reinsurance market capacities also available and certain coverages which can be probably looked at from the international insurers. So that's where there is a good synchronization between the market, what it requires right now and what is available in the Indian market or overseas. Finally, what happens is why we want to stress upon a kind of a program structure, or why we should structure those policies and what all is available, is because invariably insurance is taken as an expense for most of the companies. It can be a financier requirement. It could be anything where they feel that it's an additional burden to my overall cost that I'm taking.
Right.
Where the insurance comes in as a tool is that we need to change the perception that it's not probably just an expense that's there, but it is something which is giving you a guarantee or a surety that tomorrow if something was to go wrong, then I have a good program in place. How do you ensure that you have a good program in place? By one, clearly understanding that yes, these are the exposures and this is where I may be exposed to, where I can have a direct hit on my profits, or it can also lead to a closure of a business in case there is a larger impact.
Right.
There, these kind of programs come into picture. They come to rescue to any of the corporate clients with various things, and then understand and then design and place it with certain insurance companies.
Talking about the cost structure, how expensive does it get if you want a tailor-made product for yourself?
In most of the cases, it all depends on the kind of operations that you're running and the exposures that are there. Something where we see that there are not many hazards involved may have a lower premium. Whereas if you get into a tunneling project or you get into something which is very hazardous, maybe chemicals in nature, there the cost of insurance would be higher. It also depends on the territory that people are working on. Because if in case there are goods that are being manufactured in India and exported to US and Canada, or maybe even to UK, there we see the cost of liability insurance going up because the exposures are high. It's a very litigious society. However, if it is being sent to the other territories, maybe it could be the MENA region, it could be in somewhere in Africa or in India itself, the cost of those liability claims is very less. One, it's not very litigious society. Second, the defense cost is also not that high. So it will completely depend on the kind of exposure that is there. It will also depend on the kind of product being manufactured. But in either case, whether that's very hazardous or it's an acceptable kind of a product, which insurance companies feel is not very hazardous, there are insurance solutions available. Only thing is it is priced accordingly.
How do you ensure that your assets are valued correctly?
I think it's a very good question. And in addition to the geography or the working methodologies which we are discussing, I think the record keeping or the bookkeeping is also very, very important. So the company has to classify its asset appropriately in terms of property, plant and equipment, IT softwares, etc. And then they have to be also capitalized as per the statutory requirements. So the first step in the valuation is the right accounting or booking or capitalization of a particular asset. And the second step in it would be your valuation. So generally the asset is capitalized at the cost of acquisition, which means the landed cost. It includes transportation, insurance, the commissioning or installation of an asset. And second could be your reinstatement value. So asset gets depreciated over the useful life at a particular percentage or the life which has been decided at the beginning of that particular asset. So generally companies tend to buy insurance at the written down value, which could be very less, because if the value of a particular asset after 3 years will not be the same. So if you insure the asset at WDV, then definitely you are going to get low value out of it. The third part which comes into it is about the physical verification and independent confirmations. So the company should have to have a robust process of conducting the physical verification because your assets are spread across your operations, and having the confirmation of the physical asset is very important, both from the company side, and then independent auditors also do the counting as per the company policies. And third is also the internal audit part, because internal audit guides or provide the frameworks that how strong your processes should have to be from accounting till disposal of the asset. So they provide that kind of a guidance and companies work accordingly. The next element which comes into it is about the maintenance and disposal. Because in infrastructure sector, for example, if you maintain your assets, your machineries, your plant appropriately through preventive maintenance, or if there is a breakdown, then you are taking the care at the right time, then the life of the asset goes up, and then you will have less burden when you go for the renewal of the insurance or for claims, for example.
Okay.
And second piece is the disposal or retirement. So whenever the asset has finished its useful life, what is the salvage value, which you are expecting to realize out of that asset? And in the same thing is the retirement. So let's say if I have a lease agreement or if I have a contractual agreement of that particular asset, so after the completion of a work or the completion of the contractual terms, how I am handing back that asset to my lessor or to some financial institution, for example.
So effectively, a reinstatement value is something where the insurance company compensates the client for the new asset of the same type and kind. So while you have been using that asset for maybe 5 years, 7 years, whatever that life is, in between there is a loss, there is a damage, the insurance company will pay you for the new asset. So that's why it is very important to have those right valuations in place.
What about your potential liabilities strategies that you adopt to mitigate?
Right. So there are multiple products which I would say available, or the policies which are available. So as I said, commercial liability insurance or a D&O product, your professional indemnity product, cyber, which is the emerging risk, one of the emerging risks in the today's market. So the coverage is available for cyber insurance as well. But in addition to these intangible kind of products, as I mentioned initially, for us, the project insurance and the fire or operational insurance is very, very important because it's a requirement of our contract also. So we have those kind of strategies and those kind of policies which provides us, let's say, all risk in certain areas, and then the cyber, for example, or D&O, which covers the liabilities or exposure of our balance sheet to that.
How do you help corporates to implement the best risk management strategies then?
In a corporate, it's basically a joint effort that we have with the corporates, because finally, when we are working with multiple clients on a similar kind of industry, we have a lot of exposure as to what went wrong for a particular company and what worked very well for a particular company.
Okay.
That kind of an insight, that kind of a knowledge bank that we try and create, we pass on that information to the prospects, to our clients, where we tell them that in a particular risk similar to your nature, these were the few things that worked very well for an X company, and for a few company did not work very well. So probably gathering that market information and supplying it at the right time when they're finalizing the contracts is something which is a very good input that any of the clients can get. Certainly having a knowledge on what the market, the insurance market is offering, and what kind of exposures can be checked, can be insured, has to be retained, is something next that we do. It all revolves around the whole process, from speaking to the various stakeholders of a particular company till the actual insurance users, collating the data, merging it with the kind of products that are available in the market, and then presenting a proper solution to it.
All right. I think this also brings us to the end of this discussion. Thank you so much, both of you, for being on the show, and hope you enjoyed watching the show. Thank you so much for watching. Goodbye.
Thank you.